Hey guys, welcome back to another episode of Founder Stories Business Class. In today's short, sharp episode, I'm going to talk about international tax compliance. I know it doesn't sound that interesting or glamorous, but I get so many questions and I have so many followers online who are either nomadic and they're moving around the globe and they're not sure how to deal with their taxes, or they're in the UK, they're getting frustrated with paying 25% corporation tax, and they're thinking about, should I move to Dubai? Should I move overseas? How will that affect me in terms of my tax compliance? Could that potentially save me money? And am I able to do it? So in today's video, I'll give you a few examples. Hopefully one of them will relate to you, and you'll have some more information about whether maybe you're already and you've already made that jump and you've moved overseas. Are you doing the right thing in terms of tax compliance? What are some of the top mistakes that people make around tax compliance that they're not even aware of that could come back to really harm them in the future? And what's my advice right now for you running a business? What should you do? Should you stay in the UK and pay your taxes, or should you consider moving out of the UK? So when we talk at Growth Factor about tax planning, we break that down into three main areas. One is maximizing your tax deductions. One is, number two is global tactics, which is the topic of today's video. And number three is strategic tax planning. So an example of why global tax planning is important. We had a client that runs 7-figure IT consulting business with an 8-figure valuation. I think the company's valued at about £40 million at the moment. We are helping them talk to investors. We created a valuation model. And because we know that this particular entrepreneur wants to exit their business in the next 3 to 5 years, once they hit that 200 million valuation, which they've got as their main goal, we are already starting to think about, well, how can we minimize their personal tax liability? Part of that is that they are an individual, they're not married, they don't have kids, so they're very flexible in terms of where they move to, where they become tax resident. And so instead of right now advising them to distribute money from the company and get high levels of tax or personal income tax right now, we have restructured the way that this entrepreneur pays themselves. That's going to save them about £300,000 between now and when their business exits, when that deal is done. And when that deal is done, if no tax planning was conducted, they would be hit with a really, really, really big capital gains tax bill. Now, when we talk about global tax planning, just taking a step back, we've got to think about the different taxes. One is the sales tax that you'll pay. If your turnover is roughly over 85k in the UK, you're going to pay VAT, value added tax. 20% on top of everything you sell will have to go over to the government, less any VAT that you reclaim. You're going to pay corporation tax. So in simple terms, 25% of your profits have to go to the government as corporation tax, which is high. And you're going to pay income tax, which can be up to 45% of your income. So if we look at it in the worst case scenario, this client could be getting taxed at that higher rate, with the last level of tax being capital gains tax. They could make 100 million in the sale of their business and have to pay 45 million in taxes instantly across to the taxman. Now, that can be avoided in certain circumstances if that client has made themselves a non-UK tax resident and has achieved tax residency somewhere outside of the UK that has no capital gains tax or very low levels of capital gains tax. So if you are planning to build a business and exit that business, every circumstance is unique, but I would recommend doing some exit planning and looking at the avoidance of the capital gains tax. That's the tax that you'll have to pay on the gain you make when you sell your business. Putting that aside now, if you are a business owner, let's say you're a fitness coach, or you're running a marketing agency, or you have an online product, or you're an influencer, and you make 100k a year, that 100k comes into your business. First of all, you're having to now charge 120k if you still want to make 100k, so that you can pay the 20 to the taxman in the form of value-added tax. Now you've got your 100k left. Of that, you're going to pay, let's just assume for simple terms, 100k is, there's no expenses against that. So if you're running a really simple business, maybe you've got an online product, your marketing is organic, you don't have any team members, just for the purpose of this example, £25,000 is going to go to the taxman in the form of corporation tax. You're left with 75k. Now, if you take all of that out of your business, you're pretty much going to get taxed another 40% roughly. There are different tax brands. Yes, you get some tax-free dividends. Yes, some of it will be at 7.5%, some of it 20%, some of it 40%, some of it 45% potentially. But let's just say roughly 40% of it, 30k-ish again, comes off. So you're left with 45k from your 100k that you started with. Now, this is not a great situation for an entrepreneur to put all that work in and be left with less than half of the money that they started with, which is why so many people think, well, why don't I just move out of the UK? Now, I work with lots of coaches, lots of consultants, lots of people in the fitness industry, and they have done exactly this. So what are your options? Well, you can move out of the UK, and so long as, in simple terms again, you spend more than 6 months out of the UK within a year, you should be able to become non-resident for taxes in the UK. So you're not paying or liable to personal tax in the UK anymore. So now we're avoiding this personal income tax. Great. However, let's assume you're not nomadic and you're not moving around the world, which is a minefield to work out where you're going to register for personal taxes. Let's say you've moved to Dubai. You go and move to Dubai, you apply for an entrepreneurial visa. You're not subject to any personal income tax right now, so you've avoided that tax. Great. Simple terms, spend more than 6 months out of the UK. Caveat to that is, and I'll try and keep this video as short as possible if you're listening to this as an audio, what people don't realize is you're saving, let's say, 40% on income tax, but unless you're really, really clever, the cost of living in Dubai is definitely 40% more expensive than it is to live where I live in the Midlands in the UK. So yes, it depends where you live. Do you live in London, which is really expensive? Do you live outside? But you do need to not forget that I can go to the co-op and buy a can of Coke for 49p. You cannot do this in Dubai. It will be more expensive. So are you better off? You know, that's probably the subject of a future video, looking at the actual running costs of your grocery shop, your rent, and all these other things. That would be quite a cool video, actually. I think it's probably touch and go whether you're better off. So you have to consider that. However, if you are able to reroute and move the base of operations for your company from the UK to somewhere else, now what this will do is allow you to also avoid the 25% corporation tax. Now, if you're avoiding the personal tax and the corporation tax, combined taxes of 60 to 70%, I would say, you know, you're probably almost certainly going to be better off, especially if you aren't going out to Nobu every night for dinner in Dubai, you're shopping in local supermarkets, you're going to the old town, you're actually having a consideration for your budget. In this scenario, what do you need to do? Well, if you run a product-based business, and these are really simple guidelines, and I would recommend, if you're thinking about this, to have a personal consultation, because tax is complex. Don't let anyone's mate or person down the gym or person that you see in your co-working space say, oh, well, this person did this and you just do X, Y, and Z and it's super easy. It's not. That person, if they are doing it and they've had professional advice, it will be unique to them. If they are doing it and they haven't had professional advice, they're almost certainly not ticked a certain box, not doing something correctly, and the taxman can come back after you, you know, for up to decades after you've actually done something wrong. So you don't want to put yourself in a really good financial position and then have the taxman come and knock on your door and say, oh, actually, you were a UK tax resident for the last 7 years, so you owe us £1.5 million in taxes. Definitely you need personal advice. That being said, if you have a product-based business let's say it's an online course, you've already pre-filmed all of that content, you don't have any live element to your coaching, you're not delivering, or even if you are doing the delivery, you physically are doing that delivery from outside of the UK, you should be able to move your company to the location of your choice. If you're actually doing live coaching and consulting, you're doing one-to-one, that kind of thing, usually the company will have to be registered in the country where you reside. So if you've moved to Lanzarote, for example, and you're delivering all of your stuff like this on Zoom, you're going to have your company in Lanzarote, and it depending on where you register, you may be able to register yourself personally somewhere else. Okay, it all depends. Where do we live? What are the local tax rules around that country? Setup of companies, and do you have to register for personal tax? I had a client that moved to Mallorca. They're Spanish. They're very strict. You have to have the company in Mallorca, and you have to be a personal tax resident in Mallorca. Now, there are lots of people who go and live elsewhere. Monaco, for example, they might have personal tax residency somewhere else, like the Bahamas. They might have companies set up in the Cayman Islands. And this is all possible if it's the right type of company. And then the simple rules are, do you have a team, and where are they located? Because if you have a management team or a delivery team, the company will usually have to be registered where they are located. So where you have your friend from your co-working space or down the gym or wherever who still lives in the UK, who still delivers in the UK and is saying they're going to set up a company offshore, not possible. What they might be able to do is, if they personally spend more than 6 months out of the UK, to go and remove or move their personal tax liability from the UK. But if they're coming back into the UK and they're doing the delivery in the UK government will say that element of the delivery or that element of your business needs to flow through a UK limited company, because obviously the UK do not want to miss out on the tax revenue. Okay, so what are some common mistakes around this? Well, people go and register offshore companies, but they still live in the UK. People go offshore and they don't consider the increased living costs, the element of that. People don't go offshore and actually go somewhere they want to live. So they end up spending loads of money, 10, 15,000 pounds on company setup. And then they move back from Dubai to the UK in a year because they realized it's too hot for them. They don't like the culture. They miss the UK and all of these things. So what's the conclusion of this short video? It may be possible, and you should definitely have an awareness and an open mind to your type of business. And if you're running an e-commerce business, for example, and you get to a certain size, there are definitely opportunities for you to deliberately set up your management team, your distribution, and your company in a group structure in such a way that you're not registering that company in the UK, you're registering it outside the UK, especially if you sell globally. And you might not be paying corporate tax at 25%. You might be set up in Cyprus and paying it at 5% or 8%. So it's only possible if you're a small company, primarily if you move out of the UK for more than 6 months. If you're a big company, it will depend on your individual circumstances, but it is possible if you have the right tax planning, you do things by the letter of the law, you do not try and be smarter than the tax man, because we are not. We should only go and set up offshore if you are actually allowed to, according to the UK government and HMRC. So I hope that was helpful, guys. Definitely have an open mind when it comes to the global tactics around tax planning. If you've got any questions at all, drop those in the comments and I will answer them personally. And I'll see you in the next episode of Founder Stories Business Class, where we will be discussing what are the right systems, what are the right IT tools, can you use automation and AI around your accounting and financial information. Do you even need accountant anymore? Or can we just ask ChatGPT to analyze your financials and give you the advice on how to save tax and grow your business? My name's Simon Kallu. I'm the CEO and founder of Grow Factor, and I will see you in the next episode.